Good evening, everyone. We'll just wait for a couple of minutes before we start. Thank you for joining in. Okay, so let's start. Hi, Vishal. Good evening. Thank you so much for joining in from Mumbai. I know it's pretty late. Thank you so much for taking the time, Vishal.
Yeah, and good evening to all the listeners, all the viewers.
Just to give a quick brief, this is a series that's called Meet the Experts. Incidentally, I met Vishal on a video call some time back, and his knowledge on commodities, especially commodities, actually startled me. And that's when I thought, okay, let me start this series with a commodity series, which is around silver, gold, and any other commodity if you like. Just to introduce, Mr. Vishal has cleared his CA. He's a CFA. He's also an FRM, and he's been with MIRAE Asset for about 5+ years now. With MIRAE, he's actually launched about 50 passive funds, which includes some few ETFs, few target maturity funds, few index equity funds, and also 18 domestic and global funds. So he's a principal officer for MIRAE Asset PMS as well. And of course, today he's going to talk about extensively about gold and silver. But if you have any further questions, or if you have any questions to start off with, please do type in here. I'll be more than happy to get it answered by Vishal itself. So Vishal, thank you so much again. I'll straight jump to the thing that I really saw on in your presentation, which said gold stabilizes while silver amplifies. Right, that's what you had mentioned. So I just want to understand for the benefit of the viewers a bit more about this specific line that we are talking about.
Sure, and I think since you started the weekly series and couldn't have been better topic than both the metals. I mean, commodity, silver, of course, globally you would have seen copper, platinum, palladium also moving, doing the rows across. But from the investable investment framework for all the Indian investors tracking both the bullion metals. Now, when we set out that statement, gold stabilizes your portfolio and silver amplifies. What we wanted is to inherently draw investors and everyone's attention towards the characteristics. And I'm sure most of you would have been aware about it that gold generally moves very much in tandem, steady compounder. If you see specifically, of course, last 4 years, it has amplified a lot, but over long run, it has been more of a steady compounder, always deserved a place in asset allocation. A decade back, that allocation might have been 3 to 5%. Right now, it warrants between 5 to 15%, depending upon your risk appetite, investment framework, etc. Whereas silver has been something which has always rallied cyclically. Unlike gold, which is predominantly used as an investment by central bank, jewelry is one of the biggest driver. Silver, 65% of silver demands come from the industrial, of which 35% or more is photovoltaic cell. Since 65% demand is industrial, automatically it is tied to the industrial cycle, which means its behavior will be always cyclical. Its performance will be always cyclical, just like most industrial stocks when you see, right? In terms of equity, when you look at stocks, you generally classify FMCG, pharma as a defensive asset allocation, right? Whereas something like metal reality is more of a cyclical, that you want to ride the wave, and once the wave is done, you probably want to go back to your asset allocation. And that's what the statement inherently referred to, that gold intends to stabilize your portfolio, whereas silver intends to amplify your portfolio.
Got it. So your primary point is gold is like our FMCG in equity, while silver is more like real estate, right?
Yeah,
So
from the commodity perspective.
yeah, does it mean, Vishal, that the timing is very crucial when it comes to silver, unlike maybe in gold?
Yeah. So if you look, silver does not make a lot of case for strategic asset allocation in terms of when you are deciding, your portfolio, a goal based bucketing approach or other sort of approaches, retirement corpus building approach, etc., kind of an asset allocation from your investment framework. What you will always see is silver call will be always tactical, which means,
Okay.
because in long run, for instance, if I give you a number, for last 3-year rolling returns. I would like to talk specifically in terms of rolling return and not in terms of any point to point return. In terms of rolling return, 3 year, if you see gold, MCX Gold India Spot has moved somewhere around between 12.1 to 12.5%, whereas Nifty 50 has also moved similarly, 3 year rolling return. So which means it makes an equal case in your asset allocation portfolio from strategic. Whereas silver, what you see here, periodic performance point to point, what it will tell you that because of recent rally, you look at the numbers being slightly amplified, but largely in terms of rolling return, it will lag your equities, right? So most of your silver call, because it's amplifies, it's cyclical, you want to time it right so that your entry, and when I say you want to time it right, you want to time your entry as well as exit right? There are two stages of timing when you're trying to time the market. It's not only the entry, it's also the exit, which makes it very harder for silver. And if you look at the framework as well as where gold stays in terms of its return behavior, it's very much consistent with how the equities have behaved, which means you'll have a period of stagnated returns, whereas these returns for silver are more sporadic in nature.
I mean, just digressing a bit on the silver versus gold discussion, right? But gold also goes through this phase that's more like what is called as a dead money risk or dead phase, right? I mean, like what it was, dead zone, where
Yes.
we see no movements for a significant period, as pointed out in the chart here.
True. So this was the whole purpose of bringing this frame, that although your goal has rallied significantly, do not deviate from your asset allocation. Just because you're looking at point to point return for last 3 year, 4 year, gold being outperforming the equities,
Yeah.
traditional fixed income, do not mistake a commodity for a fixed income or a equity. It is not a replacement to those asset classes. It's a complement. And this is the chart that actually highlights specifically that what happens is generally, right now we are living in a macroeconomic geopolitical environment where risk is off, right? Because you don't know tomorrow what embargo is getting announced, what kind of a trade is getting announced, which country launches an attack on which country, right? So there is a lot of unpolitical geopolitical uncertainty which we are living right now. But once this switch turns off, which means your market is risk on mode, where you have complacency, where everything is moving towards, let's say, globalization and etc. That's when you will start moving out of a non-yielding asset like gold, and you move to yielding assets like equity, debt, etc. Right? And this is a period that gets quantified as a dead money zone, because what happens is your gold moves in a range bound manner. It
Yeah.
doesn't give significant drawdown, but it doesn't have a significant upside also, right? For example, if you see the chart what we talked about, 2012 to 2018,
Yeah.
flat 4% negative CAGR. So it's not significant drawdown, but not significant upside as well. And that's why your asset allocation has to be key. Why you are adding commodity, it cannot be a replacement to your equity, it cannot be a replacement to your fixed income. It needs to complement both of those existing set of investments. What you need to see and assess is what is your overall allocation to the commodity within your investment framework, asset allocation framework. It needs to fit in. Do not go overboard, else you'll get stuck in this dead money zone.
Okay. Okay. One question around gold again, Vishal, right? A lot of us want to build dollar assets, right? And that's one of the reasons why we invest in many international funds, right? Is gold a better alternative? Because most of the international funds, unfortunately, don't take money, right, after a
Right.
certain point in time. But
Right.
is gold a good alternative instead of investing in those international funds? Can I actually invest in gold and consider it to be building for my, let's say, kids' education or my, let's say, international trip in the next 5-10 years or so?
Yeah, so there are two aspects to it. So when you are investing gold from the point of view of as a replacement to your existing international bucket, what gold definitely offers you the edge, which is depreciation of INR, right?
Yeah.
Because ultimately India is a price taker market. India is a net importer of gold. We do not produce or export gold significantly. Net on a net basis, we are net importer of golds. We are price taker. We do not set the prices in the global market context. Now,
Yep.
because of which, what will happen? Whatever is the INR depreciation, you will get benefited by that. However, it will not be able to suffice your equivalent goal of, let's say, for instance, I want my kid 10 years down the line to study in top M7 universities in the United States. I would probably want to stay invested in the US asset. Gold is not a US asset, right? It is ultimately asset class held across the globe. So what will happen is its return from that perspective, goal based investing bucket perspective, it will always fall short of what your S&P 500 simply just investing in spider or triple q can give. Will be
Mhm.
slightly better than, of course, INR if the depreciation continues, but I probably fear that it will not be able to entirely meet that goal based objective of foreign fundings that you are looking at, probably from the gold alone itself.
So it's not a great replacement, is what your thought is.
No,
For
it cannot replace.
it cannot. Okay. Going back to silver again, Vishal. So my question is, what suddenly happened that there is so much demand for silver? I mean, what changed overnight or over the years that everybody is going gaga over silver and demand especially?
Right. So I think from the spectrum of all the precious metal that you look at, on one spectrum you have gold, which is safest of the safe haven. You do
Hmm.
not see gold inventories moving out a lot because largely it is held by central banks who are one of the largest holders. They do not invest in gold for trading. They buy it for the diversification purposes, for the strategic disinvestment purposes. Whereas silver, on the other hand, you have its tendency to fall between gold and copper. Copper is the most traded, industrially used metal class. Now, what has
Copper.
happened last 6 7 months is lot of investors who are tracking, right? Because everybody wants to be ahead of the market. Nobody is looking at the lagging indicators. People try to make draw inference from the information about what is the inventory of copper, other metal class at a COMEX, at a Shanghai Futures Exchange, just like MCX India Spot, right? They roll out whatever is the inventory with the warehouse, how many future contracts are getting rolled forward. Now when future contracts are getting rolled forward, which means likely is an indication is people do not want to take delivery. On the one
Hmm.
hand you have a speculator, on the other hand you have the hedgers, which are the industrial manufacturers of this, who use this copper silver as a raw material in their product. Now what has happened interestingly in last couple of quarters, people have seen a lot of copper inventories declining, which means people are not rolling over that contract but in fact taking delivery positions, specifically in the Shanghai Future Exchange market and the COMEX. Now that gives an indication that the domestic industrial demand in China, industrial production is expected to pick up. Now, once your copper inventory starts declining, that roughly translates to uptick in the industrial production happening in the China market. And because your industrial production is going to uptick, as we discussed earlier, 65% of the demand is industrial across the globe. China is one of the largest manufacturer, producer, and consumer of the industrial demand. And what you are bringing here, right on the screen, new age energy sector. I think a lot of silver emergence or resurgence has happened because of the rise of solar photovoltaic cell, which uses 35% of the silver. China is main market for all this economy, right? From production as well as consumption perspective. The
Right.
expectation is the production is going to take place, and how they are making that inference is not based on the inventory, because that inventory will take a lot of time, the final inventory to come out. But just because the warehouse inventories of copper etc have started declining, that is loosely translating in terms of a signal that okay, industrial production is picking up. Now what we need to watch out is ultimately if your industrial production is picking up,
Hmm.
whether it is going to get consumed domestically in the Chinese market. And that's the reason where this rally of the silver will come to know whether it's structurally sustainable or it will break through, right? What you are seeing here in long term, where the industrial demand has been bedrock of the silver resurgence. But largely now the industrial production has picked up. Now 2 quarters down the line, does it get consumed enough across the globe? And more importantly, does the domestic consumption of the silver made appliances, specifically photovoltaic cells, etc., pump up? If yes, your silver rally will be structural,
Okay.
and that's what people are betting on, that it is likely to be a lot more structural. But we'll say that you'll have to be a bit more cautious in terms of how you are approaching it, because a lot of times silver has given this false hope. Ultimately, we'll have to see upcoming two quarter number of the Chinese domestic consumption economy to know whether the rally is sustainable or not. But the question that you asked, why so much rally has happened, is lastly because of last 6 month rally that you have witnessed in terms of decline in the copper inventory across the market, Shanghai Futures Exchange, COMEX, and of course reduction in the rollover happening of those future contracts. That's what market is making inference about.
Got it. So that's why there is a supply shortage while there's a demand that is outpacing. Now, how easy it is to? I mean, one of the things that I have been thinking is sudden resurgence of gold happened when there was an unexpected demand from central bankers to buy gold instead of dollars. This was in 2022, right? Which was a maybe a unique, maybe once in a lifetime kind of an event, because was not expected. Now people are also claiming that that's quite possible with silver as well, with Russia saying I may buy silver as a gold as a reserve, with Saudi saying I may buy reserve. Is it really possible to have some part of their reserve as silver? Is it easy?
See, theoretically, it looks good on paper that they can have a reserve making form of a silver, but we'll have to understand in terms of a context, right? Silver is a very heavy metal. Like, for instance, one basket of any of domestically traded gold ETF is of 1 kg, whereas silver gets traded in a 30 kg bar. So that is
Okay.
always compulsory. So irrespective of which AMC you are investing, globally also, when you are investing in a LBMS certified ETFs, you get one basket of ETF equivalent to India gold ETF is 1 kg, and silver generally gets traded in a bar of 30 kg. So automatically, as your volume increases, that's why if you see a lot of total expense ratio of silver ETF is always higher than the gold ETF in India. If you compare and stack your
Hmm.
economies of scale of maintaining just holding the silver stock is very high, right? So that is the first thing that makes it slightly less intuitive. Second is we'll also need to look at whenever silver gets traded, right? So whenever silver gets traded, it never gets traded in the exact 30 kg quantity. It gets traded as 29.5 or 31.5. Now the reason is silver as a metal and asset class, it fluctuates because of the oxidization exposure it has, which is not the case with the gold, right? The gold, if you end up holding it for 300 years down the line, passed down to 3 generations of your, it will come out same without any rustiness or oxidization in it. Whereas silver will have that issue always. And this is what, if you talk to the industry, whenever they are buying and transacting in silver ETF, they never, very rarely they get exact 30 kg bar. Always they'll get a bar which is more than 30 kg or less than 30 kg, and they adjust in the cash component and give equivalent units
Yeah.
of those.
Mhm.
Now this becomes the storage aspect of what it brings, the metal actual chemical periodic element aspect. And third and most important is, uh, now let's say if I and you, Anand, we have to transact, right? We do a barter transaction. Exchanging 1 kg bar is lot simpler than exchanging 30 kg bar, right?
Oh
My
yeah.
transportation arrangements will be way lot easier when I am doing that. So even if you look at in terms of strategic diversification, which people are talking about,
Hmm.
that that countries will move away from dollar and etc. Of course, we can have a separate discussion on that. But in essence, transacting in a gold is lot more easier, less storage convenient, less headache, so that operationally it's more feasible and easy. And third and most importantly, the weightage of silver that keeps fluctuating due to the oxidization exposure, the bar size itself is a very quantum, right? For example, in a room of, let's say, if I have a box and that box can hold only 1 kg of gold, I can never be able to put silver bars, right? Whereas gold, you get transacted mostly 1 kg, silver, you get 30 kg bars. So those differences make it very different. Of course, what you said, for strategic purposes, some country may end up, holding silver, but let's say something like China, if they do, more importantly, because of what we discussed, silver
Yeah.
becomes an element and metal of national importance, because China is one of the largest industrial producer. A lot of these photovoltaic cells, solar panels are getting manufactured. A lot of this new green energy that you shown on the screen gets
Yeah.
taken place in China. So that may be the strategic reason. But unlike gold, I doubt it is being used to, as a hedge for dollar or etc.
So it's purely an industrial commodity, and you
Yeah.
personally don't see it to be like a reserve, because that is something which has been on my mind, saying what has changed so much that people are, other than the industrial reasons, people are talking so much about silver. Now, again, I'll just shift back to gold, and this is related to both on interest rate cuts and also to do with treasury at about 4% plus, right? Even Naveen has asked you a question. So uh, when what happens when there's an interest rate cut? Does the gold go up or down? We will talk about that. And also there's one question where they say, where he's asking, if the US treasury central banks are earning about 4% per annum, how long will the central banks keep buying gold when it doesn't yield anything at all?
Right. So I think both questions are very intriguing, because see, firstly, foremost, market doesn't move in isolation. So there are a lot of other compounding factors which will take in place. Right now, firstly, what happens is simply because when you decline a rate of interest, you definitely make a non-yielding asset more attractive than an yielding asset. So whenever you see a Fed cutting down its rate of interest, automatically you see resurgence in the prices of gold. Right. That's very simple. Is that you make comparable lot. Now coming to Naveen question, I think this is very fantastic question. Is rather than looking at yields, what you need to focus on, what is the neutral rate of interest, because your neutral rate of interest, which is real rate of interest plus inflation, makes your nominal rate of interest. Now most of you, if you would have followed what has been made out a statement 3 weeks back by Fed chair at the Jackson Hole, he clearly pointed out that US for next decade is entering into a territory where its neutral rate of interest is going to be higher than what it was for the last decade. Now, what this means is the real rate of interest for the United States will remain higher compared to last decade, as a result of which automatically you will have a potential cap on the prices of gold to what it can rise to. Now, theoretically, as I said, this should have brought some correction, consolidation in the prices of gold, but we have seen gold rallied a lot in last 3 weeks as well. Why? Because other domestic factors like the geopolitical risk, a Middle Eastern country bombarding another 4 5 Middle Eastern countries, right? The
Hmm.
tariff itself giving the uncertainty to the Fed. The problem is not the announcement of tariff. The problem is Fed cannot give a direction to the economy where it is going to head in terms of what it is going to do. Even if you look at last year's statement as well, before the current US president came into office, the Fed chair pointed out the biggest risk is the tariff risk, because that gives, you have one time inflation and then you have, of course, structural change because of those tariff cuts. So in isolation, theoretically, immediate rate cut will be positive. It has been already priced in. Next couple of days, you will have the outcome of the Federal Reserve. In long run, and this is where we feel, there will be cap coming into the prices of gold, because what 3 weeks back has been said, that the real rate of interest in the United States has moved up, which is what combines with what Naveen's question was: how long can you hold a non-yielding asset if you have a yielding asset giving you
Yes.
4%? Now the problem, what is happening, Naveen, here is that the problem, everybody knows dollar will pay off 4%, but if I hold my entire reserve in dollar compared to gold, and tomorrow the US dollar authority or the competent authority announces a embargo that you cannot trade in dollar, you cannot settle transaction in dollar. Most countries, if you look at the biggest physically traded commodity is crude oil, right? Most countries are net importer, and the major exporter is United States, 22%. Next is Saudi Arabia at 11%. In fact, Canada also is one of the top 10 who exports 98% to the United States. You have entire Middle Eastern economies GCC, whose currency is pegged to dollar. So most transactions are getting settled in US dollar, and you want crude oil, right? Any nation wants crude oil still. So what they like is, in such scenario where they have embargo lifted upon their use of dollar, what they can do is they can simply sell off the gold in the gold market, and of course take dollar and pay off the crude bill. So that is the strategic diversification reason. But from interest rate perspective, what I said, in isolation, ideally we should have seen some correction, consolidation in gold prices, because your neutral rate of interest has potentially being going to go up. In fact, that should actually cap your equity valuations as well, because that is the discounting rate of factor that you're going to use. But we have not seen that. Why? Because your other near term impacts, which is your lot of geopolitical tariff, the geopolitical uncertainty, tariffs, the current ongoing war, escalation, de-escalation, that continues to dominate. So it's always the scale of domination which will favor over the one. But this neutral rate of interest should cap the prices to what gold can go above.
So if someone were to ask me a relationship between interest rate and gold and silver, higher interest rate is generally negative for this commodity in general cases, if that is a dominating factor.
Yeah, but the only caveat is that high rate of interest should not be driven by high inflation. So you'll have to subtract, your interest rate is nothing but your real rate of interest plus inflation, right? So if your inflation is dominating a lot of part of this interest rate, what will happen is you will favor gold, because of course gold has more better purchasing power than dollar or any other fiat currencies. So largely, technically, it should be always the theoretical real rate of interest or neutral rate of interest. Higher the real rate of interest, lower will be the prices of gold, or there will be cap in the prices of gold.
And this should be only linked to US, or it should be global inflation and global.
So largely what happens, Anand, US being the most dominated one, and as I said, because of the petrodollar effect post 1970, largely world economy revolves around what is the neutral rate of interest happening in the United States.
Yeah. Okay. So those guys will continue to, at least interest rate wise, US is the most crucial at this point in time.
Definitely.
Yeah. Okay. One related question I got is, are sovereigns, banks, or countries still like the way they did in 22, 23, 24? Or do you see them not buying enough, like what they did earlier?
Yeah. So right now, if you see, central banks collectively hold around 36,000 of tons of gold to their reserve, which is around 25% of total demand, right? For last three consecutive year, they have bought more than 1,000 ton of gold. And now what has happened is, because of the prices at which they are, if you see in August, July, the demand has slightly, taken hit. But that is also largely because of de-escalation that we have arrived at, right? We have seen the de-escalation happening in the Southeast as well as in the Middle East. What is very interesting, and which you pointed out, before at the start of conversation, so I'll just borrow it from your sentence. You said this was a very one-time shift that has happened, right? Central banks buying. Now, what this one-time shift entails post 2020 is, this is a structural shift in the demand drivers of gold. Before 2022, when you are evaluating gold, you are largely evaluating based on the jewelry consumption coming from India and China. But now, going ahead 5 years down the line, any analysis will always factor what is the central bank demands expectancy that is going to be there. Now, there are two aspects to it. If we are moving in direction, and I think we are somewhere moving in the direction, even post current US presidential term gets completed, every sovereign authority will still have that uncertainty that you don't know what is going to come up next, right? So you don't know from, we have our neighbors who have been fighting right across on the east side as well. There is a small strait. So there can be a war, escalation, whatever, we don't know. So because of which, what will happen is, any drop that may happen in gold, we see central banks pumping up their purchases. Now, what this means is, structurally, the central bank buying will effectively give you a floor to what the prices gold can fall. And this is a very interesting phenomena. Now we are probably moving in a direction where you have US neutral rate of interest moving up compared to a decade back. So that puts a cap towards the prices of gold to what it can go in long run, right? And on the floor side, you have central bank buying helping around. So now you have a upper bound and a lower bound predominantly in terms of you can envisage, okay, this is where the floor will set in and this is where, the upper bound can be. Of course, nobody can give you that number, to be very
Right.
honest, because as I said, in isolation, I can talk about it upper bound and lower bound, but structurally it gives you a thought process to, okay, this is where my asset allocation has to be, this is where I am right now, this is how much I can take exposure as well, and this is where I need to uh, trim down my exposures and etc. But these two factors, in long run, the central bank buying will potentially act as a floor towards, because the central banks, and you'll appreciate, they do not trade, right? They do not buy
Yeah.
for trading purposes, unlike us, right, where we are buying, selling on a daily basis. They don't do that. They buy for strategic diversification, for de-dollarization, etc. And in May 2025, if you look at what has happened is, earlier your reserves were made up of US dollar first, second was euro, third was gold predominantly, and then you have IMF special drawing rights. But now, if you see, gold has overtaken euro. So
Yeah.
now it is still dollar, but gold is has overthrown euro, and it is the second most part of the foreign currency reserve. The only caveat is it's your 5-6 central banks that have dominated the purchase, predominantly countries from BRICS, your Russia, India, China. You have Poland and Turkey. We all know for the reasons why they have been also very interested in buying gold, specifically the Turkey economy. So a lot of these 6-7 countries have dominated the purchase in last couple of years. And some of the names that we have mentioned, I think for next 2-3 years, we do not have much visibility in terms of having a cordial relationship across the globe or their neighboring partners.
Yeah, got it. So you're saying because there is continuous flow, at least if the price goes down, there may be a cap because there'll be a flow from central
Yeah, there will
bankers.
be a floor. Probably they will start. So last 3-4 months they have slowed down in terms of buying, but once there is a consolidation or a correction happening in terms of the prices of gold, which is inevitable, any asset class, there you will see central banks probably jumping in and holding more of the assets.
Okay. So we'll move to the last part now, Vishal, which is around price and what to do on the strategy on investing in things like that.
Sure.
Where I want to delve a little deeper into this gold silver ratio, and basis this, or maybe because you also have very recently launched MIRAE Gold Silver Fund, I want to understand a bit more on what is your allocation in the gold silver fund,
Sure.
and they'll put some details on what is this gold silver ratio.
Sure. So, what happens is, traditionally, see, as a human, we would like to value something in form of a sum essence, right? When you and I, we are buying, let's say, in phone, we are valuing it in terms of our fiat currency, which is dollar or INR, right? Similarly, when you're trading gold and silver, as I said, both the asset classes have always made part of their portfolio. So how do you evaluate? Unlike your traditional, which is fixed income, equities, derivatives, also to this some extent, the valuation is always derived based on the payoff. You're discounting the payoff, right? Whatever is the future expected cash flow. Of course, in
Yeah.
case of derivative, it is the association of probabilities and etc. Now, gold and silver both are non-yielding asset. So firstly, your traditional valuation methodology fails because there is no payoff coming in, right? You cannot expect a cash flow just by holding a gold, right?
Hmm.
So in terms of a value, what you do is, generally you have observed a tendency of how both ratios move around. Generally, long-term average is around 68 to 71. That's what you look at in terms of a long-term average, which is
Okay.
generally 71 percentile of a ratio, which means at that ratio, your gold, silver are fairly valued. Now, what happens as the ratio starts moving higher, more than the long-term average of 71, 72, your over next 18 to 24 months, silver generally is expected to outperform. Now, when I say generally, it is all probabilities. So around 60 to 63% of the time, silver has outperformed over next 18 to 24 months. But where gold has dominated for the rest 36% of the time. Now, the issue is, relying solely on this ratio can be misguiding. As I said, in isolation, what I said is very simple bread and butter, right? There is a
Yeah.
gold silver ratio. If it is moving up, you move out from gold, you move to silver. But theoretically, you have a lot of other factors that contribute. You have the geopolitical risk index coming in, you have the dollar index, you have the economic policy uncertainty index, you have geopolitical risk index, you have the VIX on the volatility of the gold ETF traded in the US market. So now what you do is when you weave in isolation, you're more likely to fail if you're trying to make a prediction. Of course, you can counter that by just extending your holding period,
Mm,
right?
mm,
You
mm.
keep on extending for 2 years, saying, okay, 3 year, 5 year, I'll keep it 7 year, 8 year, 10 year. It will, of course, do well when you talk about that framework, right? As long as you keep increasing your investment horizon, you keep minimizing the risk of error of going wrong, timing risk. Now, but the problem is most of us do not have that behavioral, patience. In fact, to hold for 10 years, 12-year deep value kind of, it may sound very good in theory, but it doesn't work in practice, right?
Yeah, yeah.
Now, this ratio, Anand, for last 4 5 years has been over long-term average.
Mm,
But if you look at the performance of silver has largely come in last 6 7 months,
correct.
which means for last 4.5 years, if somebody has been doing the allocation purely based on this ratio, till 4 months back, till 6 months back, gold would have outperformed them significantly, right? Because they would have been over allocated on silver as an asset class.
True, true, true.
This is where our solution oriented offering comes in. Now, when I say solution oriented offering, if I'm saying it as a solution as a word, there needs to be a problem that exists.
Yeah.
So what are the key problems? Is first is this what you pointed out, right? If you think timing equity is hard, think timing gold and silver. You look at the
Mm,
fat tail, etc., that we have given in the charts and everything. The prediction is very very tough. Second, you cannot rely on a single ratio, single metric like gold silver alone. You have to weave everything in participatory signals and the, of course, technical indicators that we imbibe in our model. Third is from a real life investment perspective, tax efficiency, tax drag that you shown earlier on your slide. I think that is a very, very important point that most people tend to ignore. Now, what
mm.
happens in case of when you're investing in gold and silver ETF, because both are listed and traded, you have a holding period of 12 months. If you hold it for more than 12 months, you will attract LTCG at 12.5%. Else, you will incur short-term capital gain at slab rate. Now, when you're switching between gold and silver, you do not want to hold silver as I said structural asset class, which means you are more likely to sell off it in within 12 months,
12
which will
months.
trigger short-term capital gain. Now, first, the headache of maintaining that log. Income Tax Act uses a FIFO method for accounting. It doesn't even uses a weighted average method, right? It uses a purely FIFO method for allocating the cost. Now, first do that, and then ultimately, if you look at this, is again more of an extreme version that you see on this slide. But what we are trying to show is tax drag is a very real concept.
True.
When you are trying to this juggling between one asset class to different asset class using asset instruments like ETF or direct stock, etc., you will end up having a tax drag, and that tax drag can add a significant part of your portfolio. So this all problem, what problems I stated, first is when to allocate, how much to allocate to gold and silver. Second
Yeah.
is when to switch between gold and silver. Third is can I do it in tax efficient manner. If you
Mm,
say me that yes, I can do it all three in this manner, then you probably don't need our the latest offering, gold and silver passive fund of fund allocator. But in our experience, most investors will probably fail at least one of these three problems that I highlighted. Somewhere down the line, timing is, of course, it very well, it's very tough to time. Doing it in tax efficient manner is more tough to time. So all this reason tells us, okay, you have a fund of fund structure which is a tax efficient. A fund of fund can buy in silver on a daily basis. It will not trigger tax. As long as you hold it for 2 years, you will get the LTCG rate. Secondly, we do not rely on a single ratio like uh, as you brought it up on screen. We do not rely on a single ratio of gold silver ratio. We use multiple indicators. Of course, gold silver ratio is a crux, a wheel where a cog in the wheel where everything revolves around it. But we use lagging gold and silver ratio. We use short term gold and silver ratio, long term gold and silver ratio. We look at the DMA short term as well as long term, and of course what I talked about, participatory signals like geopolitical risk, economic policy uncertainty risk, China economic surprise which I said it's very very important for your call in silver, that how is the China economic going to behave. So all this model fits into, on a daily basis we run the model, we get the allocation. One thing we want to make very clear, this model doesn't do 100 or 0 allocation.
Yeah.
The objective is offering a solution, and solution cannot be pragmatic. When I'm giving 100 or 0, I'm saying I'm 100% confident that this metal class is going to outweigh the other asset class, which I think predominantly we don't want to take call here. Second, it doesn't take cash call, which means at every point in time 95% of your money will be invested in either gold or silver or combination of both. So these two factors are very important. Now, where our current allocation is, no guesses, we are overweight on silver, but we are not very conservative on gold. As I said, structurally there is a cap, but current near term domination comes from the recent factors, and that's why we are somewhere around 44 to 46% in terms of gold, and we are 54 to 56% in terms of silver. So we are overweight on silver, the fund. Now, where does this fund fits in, or any gold silver asset class, not this specific, even if you're doing at your DIY level, you think you can time it tax efficiently manner, is what we have witnessed. Most people use multi-asset fund for their strategic investment in gold and silver, right? Because your most multi-asset funds get displayed as, it has equity, debt, commodity, everything combined. But the problem is, what we have seen is, on an average, nobody allocates more than 20 to 25% of their fund to multi-asset. Now, what this means is your effective allocation to gold and silver. So most multi-asset allocation is between 10 to 15 range. Okay, I'm taking just a broad average. Anand, you can correct me. But we have seen is motamoti 10 to 15% is what your allocation is. So most multi-asset fund will give you allocation of maximum 2 to 3% to gold and silver as asset class. Now, this is where we differ. I think those time were probably a decade back, but going ahead, gold, silver can make part of your, between 5 to 15, whatever your advisors, distributors decides. I think even 7.5, 10% overall part of your entire aggregate portfolio. Now, let's say you say me, Vishal, I have already allocated 25% to multi-asset, so that is contributing 2.5, 3% your total allocation, and you have individually invested in, gold, silver ETF that makes roughly around 10%. Then probably you don't need to look at our offering, except for the tax part. But for most of investors, what we feel is this probably completes your portfolio allocation. Rather than looking at a multi-asset for gold and silver allocation, you keep your multi-asset to at 20-25%, maybe that 6-7 rupees etc. out of 100 you pocket here, and you complete your 10% allocation to gold and silver. And then you forget in terms of when to switch to gold, when to switch to silver, how much to switch, am I doing it in tax efficient manner, should I enter right now, what is the call that you'll have to make. Of course, as I said, a solution means you are arriving at a trade-off, right? You don't arrive at a best of the best, but you arrive at a trade-off, and this is what the fund is all about.
Got it. And one final question. I mean, I have a lot of other questions, but I'll just ask you one final question, Vishal. What is the right method? Should we do SIP? Should we do lump sum at this juncture? Because do you see, like you said, what is the kind of price that you see from here?
No,
Not
target,
but just do you see silver doing far better than gold?
Silver, sorry, go ahead, Anand.
Silver doing far better than gold, and do you also see which is the right option? Should one do lump sum? Should one do SIP? I mean, that's my last question.
Yeah, I think at this point in time, doing lump sum even in silver, I mean, gold is definitely not recommended at what levels you are there in gold, because the problem is, which you talked about on an earlier slide, dead money risk. You don't want to get stuck in that, right? And one way to avoid that is to average out your cost. If your cost is low, automatically your expectation in terms of return to avoid dead money weight risk is very low. So probabilistically speaking, for most people from asset allocation portfolio perspective, investors, not speculator, not hedger or etc., systematic investment plan is probably the best way that you can look at right now when you're participating in this, both the asset classes via a structured offering like this. Apart from that, I think lump sum, even if you want to go, silver is probably more lump sum, and even in lump sum, I'll say you'll should probably stagger for at least a quarter, bare minimum a quarter or two, because silver is very cyclical. As I said, industrial production is expected to go up, but if your domestic demand in China doesn't support it, entire narrative falls, right? In probabilistically talking terms, what we have seen, gold silver ratio, when it is about 90, 78% of the time silver outperforms gold, 22% of the time gold outperforms silver. But let's say at that point in time, our neighbor induces an attack on
Yeah.
a small island, then everything goes for a toss. So that's why I think structurally at this level you should definitely avoid gold from perspective. Structured allocation is always better. Let's say if even if you want to do lump sum in a gold as well, you please spread it over at least a year. SIP is probably the best method from an asset allocation participation.
Okay, that's great. I think at least a fund is to summarize a fund. I think for me, at least, the tax efficiency and the timing part works very well because I don't have to really worry about taxes, which is a big overhang, and the asset allocation where the fund manager will take a call saying, okay, should I have 50% in silver or 40% in silver, whatever is this call, right? And that's one of my reasons why at Mira Money we have added this fund in our gold and silver basket now, right, Vishal? Thank you so much for the time, Vishal. I think I have all the questions that I had, I've asked, and few other questions that came through on my WhatsApp, I've already asked. I think it was an excellent session to start off with, and I'm sure there will be more questions around silver and gold. If there's any, I'll just ping you, and then you can help me out with those overall.
Sure.
Thank you again, Vishal, and it was lovely having you here.
Sure. Thank you, Anand, for having us here, giving MIRAE Asset the opportunity to present what is our thought process. I think that is very important, and just happy and safe investing to all the investors.
Right. Thank you. You have a good day.
Thank
Bye
you.
bye.
Yep.